Yeah, hello students, we are live now. Can I begin with the session? Hello, are you able to hear me? Somebody, online students, can you confirm that you are able to hear me? Okay, thank you so much. So I'll begin with the lecture today. And yeah, the screen is visible and there are no problems on that count. Can you confirm that? Okay, so let us begin. Let us look at what we have done so far. So far, in the first lecture, we have looked at, just confirm me that you are able to see what I am writing very clearly. We have looked at demand and supply under perfect competition. Okay, we have also defined a very important idea of what is called perfect competition. Okay, so this is what we have completed. Okay, and another thing that we have done is, towards the end of the last lecture we completed this, we have discussed different types of elasticities. Okay, elasticities of demand and supply, and in particular we have discussed the three main types of elasticities: price, income, and the third type is cross price elasticity. Okay, these are the three types that we have discussed. Okay, so yeah, just once confirm that you are able to hear me and we have done this topics. Any doubts or difficulties in what we have done earlier? Can I proceed? Hello, I need online students you to continuously keep confirming that you are able to hear. Can I proceed? Okay, thank you. Thanks both of you. Okay, thanks for that confirmation. So, yeah, one of the main things when you're studying for these exams, remember, is the very important role of definitions. Okay, if you forget definitions, it's very difficult to answer the questions. For example, just as a test, can you all write down the definition of an inferior good? What is an inferior good? That this is a small test. Check whether you can do this. What is an inferior good? You can, if you want, even unmute and answer the question. Any one of you? What is an inferior good? Anyone would like to tell me what is an inferior good? Prerna, absolutely correct. What is a normal good? When income increases, what will happen to the demand of a normal good? Normal good, as income increases, demand for normal good will also, yes, correct. So normal good, it will increase, normal, it will increase. So for inferior good, the case is income increases, demand will fall. Did you all get this? So such definitions you have to memorize. In case you don't memorize the definitions, it will be difficult for you to attempt the end of the problems that are asked. Okay. So now that we have discussed this, let us begin with a new kind of a new topic today. Okay. Let us look at another part which is called as production and cost. Okay, we are going to look at this concept of production and cost. Okay, so first thing is, remember, we are looking at the decisions of firms. Okay, we are looking at decisions made by firms. Okay, now in economics, firm means any organization, okay, any organization producing a good or service with a profit motive. Profit motive. Did you get the definition of what is a firm? Firm is any organization producing a good or service with a profit motive. Okay, so we are essentially looking at these, what you would call as commercial organizations. Are you all fine with this? Can I proceed? Yes, can I move ahead? The definition is clear? Okay, fine, very good, thanks. Let's look at the next concept here. We look at what motivates a firm. We are looking at the firm's motivation, that is why they exist in the business. The motivation for firms is profit. Okay, the motivation for firms is profit. Okay, and in fact we say that the goal of firm is profit maximization. MAX stands for maximization. So the goal of any firm in economics is to maximize profit. Okay, since most of your commerce students, you already know how profit is defined. Can anybody tell me how profit is defined? Profit, how is it defined? Okay, I'll just write this. Profit is defined as total revenue minus total cost. profit is the difference between total revenue and total cost. Okay. So write what is total revenue. Total revenue is the total receipt from sale of goods and services. Okay. Goods and services over a period of time. So we can think of a revenue being monthly, annually. Okay. So this is a total revenue, and total cost is the cost of producing goods over a period of time. Okay, again we generally talk about annual aspects, okay, annual or monthly. So we can think of a firm's profit being calculated on a monthly basis or an annual basis. What you get profit is the difference between total revenue and total cost. Have you got this? Is this clear? There is also one related idea here. Okay. Okay. So we say profit is positive when, write that inequality, when what will have to be greater than what? When will the profit be positive? The profit for a firm will be positive when? Profit for the firm will be positive when total revenue is more than total cost. Have you all got this? Okay. And what would a situation like this be called? Total revenue is less than total cost. What would that situation be called? The firm is making what would you call this situation? Here we are saying the profit making company. There is profit. Total revenue is more than total cost. So what should I label a situation where total revenue is less than total cost? What should I be labeling? Anyone? What should I label when total revenue is less than total cost? Anushka, can you answer? What will be the situation where total revenue is less than total cost? Yeah, anyone? Prerna, anyone of you? Yes, absolutely correct. Very good. So when total revenue is less than total cost, we call this as a situation of loss. Okay, now this is a very important term. What is that situation where total revenue is just equal to total cost. What is that condition called? What is that condition called where the total revenue is exactly equal to the total cost? Yeah, if the total revenue is equal to total cost, what is it called? It is called a break even. It is called as a break even situation. Okay, where the firm is neither making profit nor making a loss. So there are three possibilities only. One is that firm makes profit when total revenue is greater than total cost. The other situation is the firm is making a loss when total revenue is less than total cost. And the third situation is when total revenue equals total cost, that is called as the break even point. Okay, so these are the three concepts. Have you got them? What are these three revenue concepts that we have studied now? Profit situation, a loss situation, and a break-even situation. Okay. Okay, online students, you need to keep responding, otherwise I wouldn't know whether I should proceed or not. Okay, very good. Thank you. Let's proceed. Okay, so don't forget this. This is very important terminology, break-even point, and when you study in later on in cost accounting, a very important idea of marginal costing. It is exactly based upon this kind of analysis, total break-even point and what is the risk and all that. Okay. So we have described what is profit and loss situation. Okay. So let us look at the next thing. Okay. If you look at total cost, we can classify costs on the basis of variability. Okay, we define, or one way of classifying costs is based on their variability. Okay, so for example, I will write something like this: TC of Q. Okay, write this. TC of Q represents the total cost of producing Q units of output. Q units of output. Is that fine? TC of Q. Have you got that? Okay. So now let us further break this down. Okay. We can write a very important breakdown of this total cost, I can write the total cost as a sum of two costs. I can write it as a sum of two costs, total fixed cost and total variable cost. Okay, so write this TFC of Q is the total fixed cost, total fixed cost of producing, total fixed cost of producing Q units of output. Are you all fine with this? Total fixed cost is the total fixed cost of producing Q units, TFC Q. Okay. Now, example of a fixed cost. Right, example of a fixed cost is, for example, factory rent. Now, factory rent is a fixed cost. No matter what you are producing or how much you are producing, the firm will always end up spending money on rent. Therefore, it is called fixed cost. Okay. Therefore, it will be cost a fixed cost. Okay. Any other example that comes to your mind about a fixed cost? Can you just text or unmute and tell me? A business firm, for a business firm, what else could be a fixed cost? Or say, think like this: salary paid to administrative staff. Correct? Every month you are paying a fixed salary bill to the administrative staff. So that will definitely form a part of the fixed cost. Any other example? So many examples. Have you all got this? Can say one more example I can give you is the interest paid on loan. Interest on loan, that is fixed payment per period of time. Okay. So such expenses are called fixed costs. Have you all got this? Okay, let us look at the diagram of a fixed cost. Suppose, for example, firm has fixed cost of rupees 40,000 per month, let us say. Okay, then for this firm, the diagram for fixed cost will be like this. Okay, fixed cost and the output. Suppose if this is 40,000, okay, the fixed cost diagram will be a vertical line like this. Have you got it? Are you able to see how the fixed cost function will, how the graph will look? How would the graph of fixed cost function look? Is it clear? Okay, thank you very much. Thanks. Okay. Now let us look at the total variable cost. Total variable cost. Okay. Now write cost which varies with output. Cost which varies with output is called variable cost. Is called variable cost. Okay. Example, raw material consumption. Raw material consumption. Okay. With every unit of output produced, you will need more of raw material. Okay. So there will be a direct connection between output produced and the raw material cost, and therefore raw material cost is a variable cost. Okay. Then another cost which we can think of as variable cost is energy used, electricity. Okay. So more is your production, greater will be the consumption of electricity. Okay. So anything that you all can think of as an example of variable cost? Can you all give me an example of variable cost? Hello, you are all able to hear me? I'm audible, right? Yeah, okay, fine, good, thanks. Just give me one. I have told you two examples of variable cost, raw material and electricity. Can you give me one more example of any one example can you text for variable cost? Anything, any cost which varies with the output produced. I told you raw material, another is electricity. What else could be directly variable with cost of output produced? Okay, it could be definitely direct labor, right? It could be direct labor. Yeah, very good. Thanks. Absolutely correct. You classify this as direct labor. Okay. Fine. So just one thing, I'm drawing the graph of total variable cost. Okay. And I'll tell you the reason for that very shortly. So if this is TVC and this is Q, our total variable cost will be something like this. You know, it will be going up like this. Okay. So initially it increases at a slower rate, and then it starts increasing at increasing rate. So this is how you get as TVC. Okay, draw it like this, and then it will start increasing at increasing rate at some point. Okay. I'll tell you exactly the reason why TVC behaves like this very soon. But have you copied? The diagram is clear. It is initially increasing at a decreasing rate, like it's increasing but slowly. But then it crosses a certain threshold, and then the costs simply start rising at a faster rate. So this is how you get TVC and Q. Okay, once you have finished copying the diagram, let me know so that I can proceed. Okay, when you combine these two diagrams, we will get the graph for total cost. Okay, total cost is total variable cost plus total fixed cost. Okay, let me just write it like this. Wait a minute. Total fixed cost plus total variable cost. Okay, if you draw a diagram like this, the fixed cost is like this. Okay, total variable cost, let me draw in red. It is like this and then going up. Have you got these two diagrams? And my total cost is simply the addition of these two costs. It's the addition of fixed cost and TVC. So it will just move this variable cost up. So it will go up like this and it will go up like this. This is the TC. Okay. All of you copy this diagram. Copy this diagram. Once you have copied the diagram, let me know. Hello. Once you finish copying the diagram, let me know about the total fixed cost, total variable cost, and TFC, TVC, and this is TC. TC is the sum of average fixed cost and total fixed cost and total variable cost. Okay, are you all there? Hello all. Soham, Prerna, Ishwari, Sadia, have you all got this? Okay, very good. Let us, what I'm doing is that for those of you who have joined now, okay, just copy these diagrams and I'm giving you exactly a 3-minute break, okay, 3 to 4 minute break. It's now 3:44 here in the clock, computer clock. In exactly 3:49, I'll resume the lecture and we will see average cost concepts and the laws of production, okay. So you take exactly 5 minutes break and then we will continue. Is that fine? Have you understood what I've said? Hello, have you all understood? Okay, fine. So I'm just going on mute and exactly in 3-4 minutes I will resume and we will start at 3:49, okay. Hello. Yeah. Hello, students. Are you there? Can we start? Hello. Hello. Am I audible? Can you confirm? Yes. Thanks for your patience, and let's proceed. So we have seen the graphs of this TFC and TVC. Our objective is now to define some more cost concepts. Okay. So we have defined TFC, then we have defined TVC, and we have just seen that TC, the total cost is simply TFC plus TVC. Okay. There are three more important cost concepts that we want to do. Okay. Let me label this as 1, this is 2, and this is 3. Okay. So fourth important idea in the cost function is to define what is called as average fixed cost, AFC. Okay, it's called the average fixed cost. This is total fixed cost. The numerator is total fixed cost and the denominator is output Q. Okay, average fixed cost is equal to total fixed cost divided by Q. Got it? Okay. So, for example, if the fixed cost is something like total fixed cost is say fixed at 100, then my average fixed cost would be something like 100 divided by Q. Of course, Q is not 0, Q is greater than 0. Okay, is this fine? If you take some illustrative values, like for example, Q is equal to 1, average fixed cost will be 100. If Q is 2, AFC will become 50. Okay, are you getting it? What I am doing? I am just dividing this. If this becomes, I am not calculate for 3, but if I calculate for 4, it will become 25. For 5, it will become 20. Okay, so like that, you can continue to calculate the AFC. And the AFC, if you plot versus quantity, you will get a continuously falling curve like this. Okay, but of course it will never touch the x-axis. It will keep on getting closer and closer, but it will not become equal to this. This graph is called the average fixed cost curve. It's called the AFC curve. Okay, so just you can continue to plot for Q is equal to 10, 20, 50, 50 and 100. Can you text me the corresponding average fixed cost? When, for example, quantity is 10, what would be the average fixed cost? What would be the average fixed cost? 100 divided by 10. So it would become 10. When Q is 20, average fixed cost would become 100 divided by 20, which is 5. When Q is 50, average fixed cost would be rupees 10. Yeah, so I'm absolutely correct. All of you type in the answer. What would be the AFC when quantity is 100? Yes, what's the what would be the AFC? What should I write here? Yes, correct. Sadia, that's right. Okay. So brilliant. All of you got this. Okay. So this is how the AFC curve will look. It was continuously falling with increase in output. Okay. Now when you come to ABC, okay, ABC, average variable cost. Okay. My average variable cost will be something like this. Okay. Okay, the average variable cost will have, ABC will initially fall, but later it starts increasing. It starts increasing. Okay, it starts increasing because of law of diminishing marginal product. Okay, I'm going to give you this law very soon. So just right now, just write this. It starts increasing due to the law of diminishing marginal product. Roughly just keep this in mind. Workers have a fixed capital to work with. So if you try to start increasing production beyond a particular capacity level, it will tend to cause a sharper increase in your variable costs, and so your ABC behaves like this, something like this. It falls initially, but then it will just start rising with output. Okay, so this is typically what will be the behavior of average variable cost. It is initially falling and then it will start increasing. And the reason for that is because you have fixed plant capacities, and as you try to produce more and more output in that plant, it tends to cause an increase in the variable costs. Okay, that is called the law of diminishing marginal product. So you get this kind of a cost curve. Did you all get this? Have you all got this idea? Very good. So now let's combine the two together. And see how is the behavior of, okay, fine, just one thing, let's just write this. ABC is TVC divided by output. It is the total variable cost divided by output, and Q is always positive. Okay, we cannot have zero or negative values for Q. And now write TC of Q, ATC, or sometimes it is simply written as AC of Q. Both mean the same thing. Okay, you can either write ATC or you can simply write average cost. Average cost of Q is total cost of producing the output Q divided by Q. Okay, total cost of production of Q divided by Q. That will give us what is called as the average cost of production. And if you were to break this down formula a little bit. Please rewrite this. A lot of maths is simply rewriting the relations that you already know. We know that TC is average, or it's T. Let me write this. TC I can write as TC. We can write as sum of two costs. What are they? Total fixed cost plus total variable cost divided by Q. That is the output. Okay. Now you know in mathematics that you can further split this because both denominators are same. I can write this mathematically as TFC upon Q plus TVC divided by Q. Total fixed cost divided by output plus total variable cost divided by output. Now you know the names for these functions. TFC divided by Q, we call that as average fixed cost. We call this as average fixed cost, and total variable cost we call that as TVC. So you can, there's another formula you can write this, that average cost is sum of average fixed cost plus, sorry, this is average variable cost. Okay, it is a sum of average fixed cost plus the average variable cost, AFC plus AVC. Did you all get this? Is that fine? Average total cost or average cost is a sum of average fixed cost plus average variable cost. Okay, and let us now look at the graph for this. Okay, if you look at the graph, on the vertical axis we have costs, on the horizontal axis we have output. Okay, now we already know that, I will draw in red, the average fixed cost is like this. Okay, this is your average fixed cost. Okay, let me draw in black the average, the average variable cost is something like this. Okay, it is initially falling. It's initially falling and then it is increasing. Okay, and in the next lecture we are going to study what is the laws that give rise to this. Okay, so we have an AFC which is continuously falling, ABC which is initially falling but then it starts increasing. Now remember, AC is sum of AFC plus ABC. So if you look at this graph, when we add up these numbers, you will always get a graph like this. Okay, we will always get a graph like this. This graph is called the AC or the ATC graph. Okay, and note one thing, average cost behaves like AFC initially. For the initial volume of outputs, it is behaving like average fixed cost. It is decreasing. Okay, and it achieves a minimum a minimum point, okay, it achieves a minimum point, this, like this, Q dash, okay, it achieves a minimum, and then it behaves like the average variable cost. Okay, so initially it keeps falling like the AFC, but after some point ABC starts playing an important role, which is increasing. So as ABC increases, the AC also starts increasing, and it behaves like ABC. So therefore average cost is U shaped. The average cost is U shaped. Got it? Why U shaped? If you were to just think like this, initially AC is falling, it's behaving like the AFC. Then it attains a minimum point, and then it starts increasing. So you end up with the average cost, which is U shaped. Have you all got this? Have you all got the idea? Is that clear to all of you? Okay, fine, thanks Sadia. What about the rest? Soham, Prerna, Ishwari and Anushka. Did you get this behavior of average cost? It is initially falling like the AFC, then it starts rising, and it behaves like the average variable cost. Okay, let us quickly rewrite and summarize the formulas that we have seen in today's lectures. We started with the lecture by defining TFC. Quickly, I want all of you to recall them from memory. What is TFC? TFC is costs which do not change with output. Okay, costs which do not change with output. Do not change with output. That is our TFC. Then TVC is costs which change with output. Costs which change with output are called total variable costs. Then we define TC. TC is given by TFC plus TVC. Okay, and we have seen that the graph of TC curve is like this. This is TFC. TVC is something like this, and therefore the graph of total cost curve is initially it is rising and then it is going up like this. Okay, this is your TC. So TFC, TVC and TC. Okay, and then we have defined, after this we defined the average cost concepts. Okay, we defined average fixed cost is total fixed cost divided by Q, and this has a graph like this, AFC by Q. It keeps on falling. Then we define AVC, which is total variable cost divided by output. For this AVC, we have something like this. It's falling and then it starts rising. This is AVC. And AC is AC or ATC is total cost divided by quantity. It's total cost divided by quantity. And if you look into this diagram, it is simply addition of these two curves like this. Have you got it, all of you? This is what we have done. Tomorrow's lecture we will try to do the laws of production that underlie these cost curves, but they are often required, and therefore I have tried to do them before I will actually discuss the laws of production. Okay, so have you all got this? Yes, online students, since only one student for the offline today. Yeah, Sadia, thanks a lot. Okay. Fine. So Prerna, I hope you have also got it, just like ants. Ishwari. Okay, good. Thank you so much. Okay, thanks online students for being there in the class. Tomorrow also try to come, if possible, try to come for the offline session, because it's very nice to see you here, and then it's easy for us to teach. Okay, maybe it's time now for your next lecture. So I will stop here, and tomorrow we will do the laws of production, which is another very important topic. Okay, thank you, and I'm closing this link right now and the recording for the lecture today. Okay.